When looking at charts, sometimes it's hard to make sense of which direction a market is going, especially when it's flat like this. And sometimes it would be really good if we could get an indicator where it would give an average price like this. So you could see the overall trend follows like this, and it goes like this. So essentially something to smoothen out the volatility. And in this video, that's exactly what I'm going to be talking about. In this video, I'm going to be talking through the definition of moving average, how you can access the moving average, how you can use it to identify trends, and what it means by moving average crosses. And I'm also going to touch on the differences between the simple moving average and the exponential moving average. And I'll also talk about some of the disadvantages of the moving averages as well. So stay tuned. What exactly is the moving average? The moving average is a trend line such as this one over here, where it takes into account the average price movements in the past. So you can get, for example, a 50-day moving average, you can get a 100-day moving average. And for the sake of this video, I'm going to show an example with this spreadsheet over here. So you could see there's dates over the last 10 days, and these are the prices of the stock on each of the last 10 days. And if I was working out an average, it would give me this. And that's what would be plotted currently as the moving average. And because this is a moving average, the next day you'd get the second over here, and then the previous date was gone, and the new average is 49, and then you got the third, and the average would go up. So the moving average continues moving to give a trend line such as this one over here. Of course, this is just one that I've drawn on, but this is something that you can actually get, is an actual thing, and you can set it the way you want as well. So I'm going to clear these drawings and show you exactly how to access the moving average as well. To access the moving average is exactly the same as how we accessed the relative strength index in the previous video. You click on indicators over here and you search for moving average. And you click on the simple moving average. And you can see the trend line that I drew earlier. This follows pretty much a similar pattern where it makes smooth the volatility. You can set the moving average how you want. You could see here this says SMA 9. So what that means is this only takes into account the last 9 candles. So if you're looking at the daily chart, this is the last 9 days, and that's why you could see it moves up and down more often. And if I was to switch to weekly, this takes into account the last 9 weeks and so on. The most common setting that you'll see people using with the moving average is 50, 100 and 200. So how do we actually change the settings like that? So you click on the settings over here, and this 9 that you see, you can change it to whatever you want. So for this, I'm going to set it as 50. And you could see the trend line, it changed. So now it takes into account 50 candles. And the same thing would happen is if I was on the weekly as well. So how do people actually use the moving average? The first thing the moving average tells you is whether the market is in an uptrend or a downtrend. Generally speaking, if price is trading above the moving average, that means the market is in an uptrend. And if price is trading below the moving average, that means the market is trading in a downtrend. With the moving average, you can use multiple moving averages. So this is just the 50 SMA. You could also add in another one. So I mentioned earlier that the 50, the 100 and the 200 are the most commonly used ones. Most people generally use, if you were to pick only 2 from the 3, the 50 moving average and the 200 moving average are the most commonly used ones. And I'm going to set it and show you. So I'd go on the settings over here, and here I would select the SMA, which is the simple moving average, and I'd make this one the 200, and I'd press OK. I'm just going to change the color so it's easier for you to see. So I'll press settings and I'll change this to green, and I'm going to make it thicker as well. And also with this one as well, I'm going to make it thicker so it's easier to see. So you could see that this blue one here is the 50 SMA and this green one is the longer 200 SMA. You could see the difference in how smooth it is. Some people, they use the moving averages as support and resistance. So you could see a few times where the S&P, especially over here, it bounced off the moving average. Again over here. And you've got the longer term bounces as well, so over here as well. And you could see it's been in a downtrend in this area. The next thing I wanted to talk about is something called the golden cross and the death cross. These are common terms used in technical analysis, and it's to do with the moving averages. Generally speaking, when a shorter term moving average, such as the 50 SMA, crosses below a longer term SMA, such as the 200 SMA, that's referred to as a death cross, because prices generally trend downwards from that. And you could see that's exactly what happened. You had the cross and then the price started going down after that. The opposite to that is the golden cross. So this is when a shorter term moving average crosses above a longer term moving average. So the 50 SMA crosses over the 200 SMA. And you could see that the price is started trending up after that. The next thing that people generally ask is, what is the difference between a simple moving average and an exponential moving average? And the answer is, the simple moving average, it takes into account the last 50 candles, whereas the exponential moving average, the formula is slightly different. So it puts more weight on the more recent candles so that the moving average changes quicker. The EMA, the exponential moving average, is more suited to shorter term traders, people that have a smaller time frame, whereas the simple moving average is more for longer term traders. And I'll show you what I mean by this over here. So let me just get rid of the longer term time frame. So I've got the simple moving average over here, and I'm also going to add the exponential moving average. So here, moving average exponential. And if I go on the settings just to make it exactly the same as the simple moving average, so I'll make it 50. And you could see, as an example over here, when the market started going in an uptrend, the exponential moving average started moving up before the simple moving average did. And even in a downtrend, you could see the exponential moving average moved down first before the simple moving average. So this is more suited for shorter term traders because it gives the information that they need quicker. As with any indicator, there are disadvantages. So the disadvantages of the moving averages is, number one, that it's a lagging indicator. You could see that it takes into account the past prices of the stock or the crypto, and so it will always be lagging in that sense. The second thing is, when the market's in an uptrend, it's good. When the market's in a downtrend, it's good. However, when the market is flat, sometimes it can give you some false signals. You might get a golden cross and a death cross within like a flat market, and you enter a trade and it might not work out because the overall structure of the market's there, it wasn't in place. So what's recommended is not to use the moving average on its own, but pair it with other indicators such as the RSI, the support, the resistance that you were taught, bull flags, bear flags. Putting all these pieces of the puzzles together to give you an overall picture is the best way to go forward. I hope you found this video useful. If you found it useful, please like, subscribe, share with your friends. I really appreciate it. Thank you.